This is Tom Jones from P6 Biz Builders. Let me tell you what happened with this client. He ran a good service business. Sales were growing. Company was profitable. Cash was coming in. They had a good accountant, but every year, tax season felt pretty much the same. The return would get finished. They'd find out what they owed, and they would write a big check. No one wants to write a big check. Of course, what happens when you write a big check? There's going to be stress. After the check was written, everyone just went back to work. Sound familiar? Here's the thing. The accountant was not the problem. The problem was timing. Nobody was stopped and analyzed during the year. And also they never asked, how are we doing? What is our profit looking like? What's our tax bill starting to look like? And what can we still do before the year is over? Once we stopped reacting after the year ended and started planning during the year, things changed. The result was more than $35,000 in tax savings. It was not one magic deduction. It was several good decisions working together. Here are the 5 that made the biggest difference. Number 1, do tax planning while you still have time to make decisions. This is probably the biggest one. If you're first talking about taxes when the return is being prepared, you're looking in that rearview mirror as to what already happened. The year's already happened. There's a few things you can do, but not much. Instead, we started looking at the numbers throughout the year. How profitable are we compared to with last year? What tax payments have already been made? Has anything changed for the owner personally? Are we planning major purchases? Are there retirement planning opportunities? And probably the most important question, if we keep going exactly the way we are going, what is the tax bill likely to be? Now, a little self-promotion for me. My most successful clients are the ones that I meet on a regular basis, whether it be quarterly, semi-annually, or monthly. Even a couple clients I meet bi-weekly. They're the most successful ones. They don't have cash flow problems. They know exactly where they're going to be at taxes. We talk all the time. I know exactly what their business is going to be, and I can advise them as to what's going on. They're getting back to the question about your tax bill. That question gives you time. You have time to prepare the cash, talk through options, and make good decisions instead of reacting to a surprise. And here's another reason I'm talking about this now instead of in December. The next individual estimated tax payment is due September 15th. So ask yourself another question. Do you know what that payment should be based on your business, how your business is actually doing this year? Not based on last year, based on this year. Because if you had a worse year, you should be lowering the payments. If you had a better year, you should be increasing the payments so you don't have a big surprise at the end of the year. And like I said, if your company is having a much better year, have you adjusted for that? And more important from a cash flow standpoint is the money sitting there ready to make the payment. Those are conversations I want my clients having now, not 3 days before the payment is due. So here's one more question to write down. If my tax bill came in $25,000 higher than expected, would my business have the cash to handle it without causing stress? If the answer is no, why wait until tax season to find out? And if you just heard that and thought, I really don't know, that is exactly the kind of thing you need that we can help you with figure out. You don't have to wait until tax season. Number 2, review how your business is structured. A lot of business owners set up their company when they first got started, and it was probably perfect structure for them. Maybe they're doing 100,000 or 200,000 sales. 5 years goes by, 10 years goes by. Now they're doing a lot more business. They have employees, trucks, whatever else. Profit has changed. The owner's personal situation has changed, but the business structure has never been reviewed after the initial setup. So ask yourself, is the structure I started with still the best for the structure for the business I have today? Now, that does not mean everybody should become an S corporation. Changing entities does not automatically save taxes. There are payroll rules, reasonable compensation rules, state taxes, legal issues, and other things that need to be considered. But your structures were worth reviewing as the company changes. If you cannot remember the last time you talked about this with your advisor, put it on your list. Number 3, look at purchases you already plan to make. And hear me out. Hear me clearly on this one. I'm not telling you to go buy a truck, piece of equipment, or computer just to get a tax deduction. Spending $1 just to save part of $1 in taxes is still spending the dollar. That does not make sense. What if you already know you need equipment? What if you already plan to replace this truck? What if you need new computers or another business asset? Now, the timing may matter. For this client, we looked at purchases they already intended to make. Then we asked 2 questions. Does buying this now make good business sense? And what does the timing do to our taxes and our cash flow? Depending on what you're buying, when it's placed in service and the rules apply to your business, there may be depreciation, Section 125, Section 179, or other tax considerations. That is something to review with your advisor. I would never tell a client to buy something just for the tax deduction. If the business needs it anyway, then let's look at whether the timing makes sense. 4, look at retirement and owner planning. I see this all the time. Business owners put everything back into the company. Another employee, another truck, new equipment, more marketing, more inventory. Everybody gets taken care of, but the owner, the employees, the customers, the vendors. And then maybe there's something left over and the owner gets that. Then or 10 or 15 years goes by, most of the owner's wealth is still tied up inside of the company. Depending on your circumstances, retirement plans may allow you to put money away for your own future while also creating tax benefits. The right plan depends on your business. Your employees matter, your income matters, your age matters, your goals matter. So you have to review it with your right advisor. But if you want to write it down, I want you to write down this question. Is my business building my personal financial future too? Or am I just building a business that hopefully I can sell at the end of time? If the company is making money, but you are not building anything personally for the future, you really should look at that, and we can do that together. Number 5 is the mindset shift that makes the other 4 work. Stop treating your accountant or advisor like a once-a-year service. The tax return tells us what already happened. Planning asks what's going to happen next. Those conversations should include more than taxes. How profitable are you? What's happening with cash flow? What are you forecasting? Are you hiring? Are you buying equipment? Are you taking on debt? Are you buying a building? Are you planning to sell the company someday? All of those decisions are connected together, and your advisor needs to understand where you're trying to go so they can start helping you think through the tax and cash flow impact before you make the decision. Because once you make the decision, if you do it yourself, it's done. The advisor can't help you anymore. So ask yourself, does your advisor mainly tell you what happened last year? Or are you having conversations about what needs to happen next? If you're struggling with this right now, you do not have to wait till next tax season to get help. We can start looking forward now. Now, let me bring this back to where we started. There was not one magic $35,000 deduction. There was no secret tax trick. It was several good decisions put together. We planned earlier. We reviewed the business structure. We looked at purchases they already needed. We reviewed owner and retirement planning. And most importantly, we started having tax conversations during the year instead of after the year was over. Together, those decisions saved more than $35,000. Maybe just as important, when the tax bill came around, they were ready for it. They didn't have to scramble for cash, trying to rob Peter to pay Paul, or where it's going to come from. There was less guessing, less stress, and fewer surprises. Before we wrap up, look at that piece of paper. You should have 5 questions on there. Number 1, have we projected our 2026 income and tax bill yet? Number 2, is our business structure still right for the company we have today? Number 3, are there purchases we already need that should be part of our year-end planning? Number 4, have we reviewed our retirement owner planning opportunities? Number 5, are we meeting with our advisor before year-end? Or are we just sending them the information after everything's happened? Now, again, I can't stress this enough. You have 2 things. You have tax preparation, tax planning. Tax preparation, one-time fee, that's it. It doesn't include tax planning. Tax preparation is just to prepare your tax return to report to the government. Whereas with tax planning, actually, I like to call this tax/business planning. It's an ongoing yearly meetings and strategies with your advisor. And like I said before, it can be once a month, once a quarter, twice a year, or even every other week, depending on what you need. But now going back to those questions, if you answered no to 2 or 3 of those questions, I would not wait until December. And I definitely would not wait until tax season. The earlier you start looking at this, the more choices you may have and the less stress it's going to cause. I will leave you with this. Paying taxes is part of running a successful business. Nobody's saying you should not pay what you legally owe. The goal is not to avoid taxes. The goal is to avoid paying more than necessary just because nobody planned ahead. Tax planning is usually not one big dramatic move. It is a series of smart decisions made during the year. Like I said, meeting with an advisor, whether it be monthly, quarterly, semi-annual, whatever, so that you have an idea what's going on. So let me ask you 4 quick questions. Do you know roughly what your 2026 profit is going to be? Do you know what that means to your tax bill? If that estimate is off by $20,000 or $30,000, what does that do to your cash flow? Would knowing that number now make it easier to plan the rest of the year? If you're sitting there thinking, Tom, I really have no idea what my tax bill is going to look like, or I know we should be planning, but nobody's helping us look ahead, why wait? Send me a private message. You do not have to put any of your financial information in the comments. We can set up a free 30-minute proactive cash flow and profit strategies session. We'll talk about where your business is today, where you're trying to go, what is causing your concern, what are the things you should be discussing with your tax advisor, and financial advisors now. If cash flow is part of the issue, ask me about my 13-week cash flow forecast. Helps you look ahead week by week so you can see where the cash may be tight before the bank balance surprises you. If it makes sense for us to work together, wonderful. Best thing around. If it does not, it's still not a problem with me. We'll still leave. We'll probably come up even with what your next step should be. But we'll part as friends and we'll move on, and you can always call me back if you decide you want to talk to me more. Because if taxes, cash flow, or your numbers are keeping you up at night, why wait another 3 or 4 months? We can start working on it now. Also, make sure to visit and subscribe to our YouTube channel at P6 Builders. We're putting more short videos there on cash flow, profit, taxes, systems, leadership, and building a company that does not depend on the owner for everything. And oh, by the way, do you know of anybody else, whether it be business or individuals, who could use our services? Somebody comes to mind, send them this video or put us in touch with them. I'd be happy to talk with them so they get that half hour free. Your tax return is important, but it is telling us what already happened. I would much rather be talking with you now while we still have time to look ahead and make decisions. Thanks for spending a few minutes with me, and I'll see you on the next live. Remember, tax preparation is one-time fee for preparing your taxes only. Tax planning, tax/business planning is something you do all year long. Keep that in the back of your mind.